Most people come into trading thinking it's complicated. They buy courses, they watch hundreds of hours of YouTube videos, they download indicators they don't understand, they sit at a 3-monitor setup thinking more screens means more edge, and then they lose money. I'm not saying that to be harsh. I'm saying it because I did the same thing for years. Here's what nobody told me at the beginning, and what I'm going to tell you right now in the next 12 minutes. 97% of what you need to know about trading is actually pretty simple. The other 3%, that's the refinement, the edge, the stuff you spend years developing, but you cannot get to that 3% until you genuinely understand this. So let's get into it. Let's start from the beginning, and I mean the real beginning. Trading is not gambling, but it's not investing either. It lives somewhere in between, and understanding where, that's actually important. When you invest, you're buying something and holding it. You believe in the long-term value. You're patient. Time is your friend. When you trade, you're saying, I think the price of this asset is going to move in a specific direction in a specific window of time, and I'm going to position myself to profit from that movement. That's it. That's the whole game. Price, direction, time. Every strategy you will ever use, whether it's momentum trading, mean reversion, breakouts, options plays, all of it collapses back down into those 3 words. Write that down if you need to. Now, here's something I want you to sit with for a second. The market is not a machine. It's not some perfect, rational, all-knowing system that prices everything correctly at every moment. It is a collection of human beings, institutions, hedge funds, retail traders, algorithms built by humans, all making decisions based on information, emotion, fear, and greed. And because it's made of people, it's predictable. Not always, not perfectly, but enough. People panic at the same price levels. They get greedy at the same points. They run their stops in the same places. When you start to see the market as a crowd psychology experiment instead of a math problem, everything starts to make a lot more sense. Now, let's talk about price action, because this is where a lot of people go wrong. There are 2 schools of thought. You've got technical traders, people who read charts, patterns, levels, and you've got fundamental traders, people who look at earnings, economic data, valuations. The argument about which one is right has been going on for decades, and I'm going to give you my honest take. Both matter. But for most retail traders, price action is where you need to start. Here's why. Fundamentals tell you what to buy. Price action tells you when to buy it. And in trading, the when is often more important than the what. You could be completely right that a company is undervalued and still lose money if you bought it 3 months too early. This is one of the most painful lessons in trading. Being right about the direction and still losing the trade. Price action removes a lot of that guesswork. You're not predicting, you're reacting to what the market is already showing you. All right, here's something that sounds almost too simple, but stay with me. Price only does 3 things. It trends up, it trends down, or it consolidates, which just means it moves sideways, going nowhere fast. That's the entire universe of market behavior. Everything else is just a variation of those 3 states. Now, the reason this matters so much is because your entire job as a trader is to identify which state the market is in and then position accordingly. If price is trending up, you're looking for long entries, buying dips, riding the move. If price is trending down, you're looking to short or stay out altogether. If price is consolidating, you're either waiting for a breakout or you're scalping the range. The traders who blow up accounts are almost always the ones who fight the trend. They short a stock that's going up because they think it's overpriced, or they buy into a downtrend because they think it's oversold. The market doesn't care what you think. It only cares what it's doing. Let's talk about support and resistance. This is the foundation. If you understand nothing else, understand this. Support is a price level where buyers have historically stepped in.
where demand has been strong enough to stop price from going lower. Resistance is the opposite. It's where sellers have consistently showed up, where supply overwhelmed demand and pushed price back down. Now, here's the part that confuses people. Support and resistance are not lines. They're zones. Price doesn't bounce off a number with surgical precision. It reacts within a range. Sometimes a few cents, sometimes a few dollars wide. And when you understand that, you stop getting shaken out of perfectly good trades just because price dipped slightly below your level. And here's the other thing people get wrong. When support breaks, it often becomes resistance. And when resistance breaks, it often becomes support.
This is called a role reversal. And once you start seeing it on charts, you'll see it everywhere. It's one of the most reliable phenomena in technical analysis, and it works because of something very basic: human memory. People remember where they got hurt. They remember where they bought and price dropped on them. And when price comes back to that level, they sell. That's it. That's the whole mechanism.
I want to slow down here because this section is more important than anything else I've said. You can have a strategy that's wrong 60% of the time and still be profitable if your risk management is right. Let me say that again. You can lose more trades than you win and still make money. How? Because of something called the risk-reward ratio. If you risk $1 to make $3, you only need to be right 33% of the time to break even. Be right 40% of the time, and you're profitable. This is the math that most retail traders never sit down and actually work out. They focus on their win rate. They feel good when they win. They feel bad when they lose. And they completely ignore whether the size of their wins justifies the size of their losses. The professionals think in terms of expected value, not individual trades, but the long-run outcome of executing a strategy consistently, hundreds of times. Which brings me to the next piece: position sizing. I don't care how good your setup looks. You should never, and I mean never, risk more than 1 to 2% of your account on a single trade. I know that sounds boring. I know you've seen the Reddit posts about someone turning $5,000 into $50,000 in a month, and maybe it happened, but for every one of those stories, there are 100 stories that don't get posted about the person who tried the same thing and lost everything. 1 to 2% per trade. That's it. That rule alone will keep you in the game long enough to actually get good. This next part is something I wish someone had told me on day one. The market will test you in ways that have nothing to do with your strategy. It will give you 3 losing trades in a row and make you doubt everything you know. It will give you a big win followed immediately by a big loss and make you feel like a fool. It will make you feel euphoric on a Friday afternoon and completely destroyed on a Monday morning. This is not a bug. This is the nature of probabilistic outcomes. And your brain is not wired for it. Your brain wants patterns. It wants certainty. It wants to feel in control. And the market? The market gives you none of that. The 2 biggest psychological traps in trading are revenge trading and FOMO. Revenge trading is when you lose a trade and immediately jump back in. Bigger size, less discipline, trying to get back what you lost. Like the market owes you something. It doesn't. And that behavior is how small losses become account-ending losses.
Oh, FOMO, fear of missing out, is when you see a move happening and you jump in late without a setup just because you don't want to miss it.
There will always be another trade. Always. The market opens 5 days a week. There is no last bus. The traders who survive long-term are not the smartest ones. They're not even the ones with the best strategies. They're the ones who learned to stay calm when everything was telling them to panic. All right, let me pull all of this together for you. If you're just starting out, or if you've been trading for a while and you're still struggling, here is a framework that works. Step 1, identify the trend on the higher time frame. Daily chart, weekly chart. Is price making higher highs and higher lows,
Or lower highs and lower lows? Or is it just ranging? Step 2. Zoom in to a lower time frame, 15 minute, 1 hour. Look for price coming back to a key support or resistance level within that trend.
Step 3. Wait for confirmation, a rejection candle, a volume spike, something that tells you the level is holding. Step 4. Define your risk before you enter. Where's your stop loss? Where's your target? Is the risk reward worth it? Step 5. Execute and let it play out. Don't move your stop loss against yourself. Don't close early because you're scared. Trust the setup. That's it. That's a complete trading framework. It's not glamorous. It's not complicated, but it works. If you execute it with discipline, consistently, over time. I want to leave you with one thought. The reason most people fail at trading is not because it's too hard. It's because they come in expecting it to be easy. They want the secret indicator, the magic strategy, the one pattern that always works. That doesn't exist. What does exist is a process, a repeatable, disciplined process that, when followed consistently, gives you a statistical edge over time. It takes time to develop that. It takes losses. It takes sitting with discomfort and learning from it instead of rage quitting. But I can tell you from experience, from years of doing this, that the clarity you get on the other side of that learning curve is absolutely worth it. If you found this helpful, hit the like button. It actually helps more people find this content. And if you want me to go deeper on any one of these topics, leave a comment below. I read all of them. Take care of yourselves out there. Trade smart, and I'll see you in the next one.